That is true. Oh, there we go. Yeah, so question is Slido. And yeah, you can upvote questions if someone already happens to be asking the same thing. And then usually what we do is just go like top to bottom for Slido questions. So yeah, get those questions in early. Slido is expensive. We're actually using the free one, Casey, so don't worry. And yes, I agree.
I'm just messing with you guys.
The paid one was a little bit like, oof, you know, maybe not now. Cool. So let's kick off. Oh my God, sorry, I'll let in one more person. Okay, just let this person. Welcome everybody to our VC Demystified event. It's awesome to have everyone here, and thank you to our lovely panelists for joining us. Yeah, let's kick off. Like we'll do a couple of intros, and then we've got some questions prepared, some spicy ones too. And we'll open up the floor in the last 20-25 minutes for audience questions. So yes, that's where we'll go through the Slido link and yeah, go top to bottom. So yeah, let's do some intros. Let's start with Casey, who's on my left.
Cool. Hi, everyone. Super excited to be here today and chat about all things VC funding. I am in the Aussie investment team of Square Peg Capital. We're an international VC, originally founded in Australia, but now investing in Southeast Asia and Israel as well. We've invested in some amazing companies like Fiverr and Canva and some up-and-comers like Rocked. And yeah, really excited to be here. I do have the Sydney sneeze or the spicy cough, whatever you want to call it. So if my answers are a little bit slow, it's because I have brain fog right now, but I'm going to do my best.
I haven't heard spicy cough before, but I feel like I'm going to use that.
I think it's my favorite.
Spicy cough. Yeah, no, sounds good. No more like COVID-19 spicy cough. Cool. I'll pass it on to Olivia.
Hey everyone, my name is Liv and I work for Skip Capital. So Skip is the private investment fund of Scott Farquhar and Kim Jackson. And Scott, as you probably know, is the co-founder and co-CEO of Atlassian. So we invest in the venture part of the business, which is where I work, pre-seed, pre-IPO in Australia and globally. Mostly in B2B SaaS, as you can imagine, with the Scott connection, but we also have passion areas in climate, in health, in Web3. And yeah, we're investors in companies such as Canva, Safety Culture, Culture Amp, Airwallex, and a whole bunch of other ones.
Awesome. And lucky last, pass it on to Isabella.
Guys, excited to be here. I had the spicy cough, don't have it anymore. I work for OIF Ventures. Similar to Casey and Olivia, we are a venture firm based in Australia, but have had one partner based in the US for the last couple of years who helps our companies, gain traction and get their first early customers in the US. The principle of how we invest is founder first. So the way that we measure ourselves is, have we changed or made a difference to every business that we've invested in? That means we have a relatively flexible mandate around, going early and following on throughout the founder's journey, and also what types of businesses we invest in. So typically the way that we look at it is, do we love the founder and want to spend the next 10 years of our life with them? Do we think we can add value to the business? And then obviously, does the deal make sense?
Awesome, thank you. And yes, as you can see, very stacked panel. And the whole point of this event is to really help any budding founders, people who might be thinking about starting their own thing, just really sort of demystifying what goes on in the whole VC space. I know Dan, John, and myself would have loved to have this maybe a couple of months back. So yes, let's get into it. So I think let's start from the very start. Let's just say I am a founder. I don't really know anyone, but I've got $1 billion idea. How do you go about cold outreach, or what is the best etiquette when it comes to cold outreach? I don't know who wants to jump in first.
Happy to. Three pieces of advice. The first is I'm typically at the Double Bay Markets on a Thursday. So you can find me at the faux stand. And that's my most happy time. So very happy to usually have a chat with anyone who wants to connect. The second is, I think, just hustle. You know, my first, it's always easier to get a warm intro into a VC from someone, as with life. But if you don't have that, I would just follow up until you get a response. And then the third piece of advice I would give is make sure that, you know, you're addressing the person and you understand who you're going after and what they do. To get in a cold outreach with, you know, not even my name, or kind of an infrastructure company looking for a tech VC, it's a very easy one to kind of pass on.
Cool. And what was the name of the markets that you're always hanging out at? Question in the chat.
They're the Double Bay Markets on a Thursday. Our offices are in Double Bay and they've got the best faux ever, as well as
everybody take notes. Cool. I think Liv, you wanted to jump in there as well.
Yes, sorry, I had some audio issues. So I would have a couple tips. I'll just echo what Isabella said as well. I would say trying to contact somebody individually is super important. So reaching out to them on whatever platform you can as a person, and do your research, you know, make sure that they, like Isabella said, they actually invest in your type of asset class, or maybe do something like, oh, I saw you invested in this company. My company is in a similar space. I would also say to kind of unpick the structure of how a VC works is that you kind of have your partners and more senior staff at the top, and then the bottom is a bunch of kind of associates or more junior staff. And their primary job is to go and source companies to then send back up to the partners. So often you're going to have the best luck getting in contact with somebody on more of a junior level, because their whole job is to try and have a coffee with you and then pass you on to the partners. So try not to go straight for, you know, big partner, big shot, because they're most likely to have the most emails in their inbox. Then the second piece of advice I would give is just about exactly the format to send somebody a cold outreach. So I would just encourage you to always send your deck. And I really like when people do two things. The first one is attach a kind of quick summary of what the company does in the actual body of the email or in the body of the LinkedIn message. And that can just be 3 or 4 bullet points. And then just attach a short deck. So I think Nick Crocker says that you kind of 12 pages is the best, and I'll take his advice considering, you know, he's got heaps more experience than me in the space. But I really like 12. It can kind of tick off all of the main themes. And yeah, you only have a quick amount of time to make an impression for a VC in a cold outreach situation. So try and just get the best of the business into those 12 slides.
Awesome.
I think those are awesome tips. Just a few extra from me. I think on 2 don'ts, like don't contact multiple people in the same firm, particularly like spamming everyone. We have CRM. So the first thing I'm going to do is open the CRM and see that you've emailed like 10 people, and it's just going to kind of irritate them and set things off on the wrong foot. The second one is don't ask for, I think this one's less known. If I say, hey, it's really not for me, don't ask for intros to other VCs or angels from me, because I'm not enthused about your business. And so if I were to set you up with an intro, it's going to set you off on a bad foot as well. If you get let's say you speak to a VC and it's like just truly out of their mandate, but they think it's really exciting, they might be more inclined to give you a much better intro, and it's just going to land way better if you get that intro. And then the last one, which is very similar to what Bella was saying, which is just like, if you can add a personal touch, I think it does make a big difference. There's nothing wrong with the cold outreach. But yeah, I feel like I pay a little bit more attention to emails when I can tell that they've tried to add something about me. Like on my LinkedIn, it's really obvious that I like sailing. If you go to my profile on the SquarePeg page, it's really obvious that you know, I'm interested in sci-fi and reading and like all this stuff. Like if someone mentions that, I'm like, oh, okay, cool. They're paying 5 seconds and they haven't like copied and pasted this to everyone.
Yeah, totally. I think the general theme I'm hearing here is like shoot your shot, but also keep it very relevant. And yeah, and I think that's something that I've heard a lot of like serendipitous connections happening as well. So yeah, anyone who's thinking about getting started, shoot your shots. And let's like say that, you've gotten in touch with someone and you've got your foot in the door, so to speak. Let's actually think about like what happens at this stage. So as a founder, what sort of like valuations should I be expecting? What type of things should I be like trying to present to you to like put myself in a good position? So yeah, what do you guys think about that? Maybe let's go the other way around. We can start with Casey.
Cool. I think I'm on Liv's point about Nick Crocker's framing. So I really like StartMate actually have like a really great blog post on this. Basically, when you're getting in touch, there's two types of decks. There's your marketing deck, which is that 12-pager Liv was talking about. And that's like quite light, just like give them a bit of a sense of what are you doing? Why are you doing it? Who are you? And then there's the board deck, which is that in-depth deck that you would actually, if you go into a meeting with them, you can like pop that up into different parts depending on what they're asking about, or if you feel more comfort with it, you can go through it entirely. And that's where you have more detail. You do not want to be sending the big like thick deck over in your intro email. It'll just like, they'll just skim it and they'll miss so many important details. So I think, yeah, have that kind of backup deck with a bit more detail is more important. In terms of valuations, I think the best advice I've had on early stage valuations is that it's honestly a bit supply and demand, and it's a lot less science than you might think. And so it does really come down to how well you position the business and how excited you get VCs. And that's all a lot of storytelling. And so that's part of it. The other part of it is that you can kind of back solve. You can think, okay, basically what I need to be doing is getting enough money to get me to a certain milestone or milestones within 12 to 18 months, the next time I want to be raising. What capital do I need to facilitate getting to those milestones? And then you can think about, okay, how much of the business am I willing to give away? With those two variables, you have the valuation that you're comfortable with. And so that just gives you a sense of what you should be playing with.
Great answer. Completely agree. Liv, do you want to jump in this?
Yeah, sure. I mean, I didn't really know how I can add to that. That was a great answer. Definitely, yeah, the two pitch deck system is awesome. I think if I can dive into what makes a really great pitch deck in my mind, I think there'd be a couple of like core things and then a couple of hacks that I would recommend. So the core things would be to focus on maybe 5 key topics. So I would say those topics are probably the problem you're solving, how you're solving it, who you are as a team, what traction, if any, and you don't have to have had any revenue. You don't need to have even necessarily built a product. We're all in this call very early stage investors. So the traction doesn't necessarily have to be revenue numbers, but it can be customer interviews you've had. And then the last one would be the market landscape, to give a bit of a sense of the market size or any competition. So I think building a deck around those kind of 5 core pieces are really, really helpful to kind of ground the key things an investor is looking for when they're looking through having those first conversations with you. And then in terms of a few hacks that I think are really helpful in pitch decks, I think investing in a really great designer or putting it on Canva, having a little bit of a go at making it look visually appealing and easy to understand, it really does go a long way. So I always encourage founders to try and make their decks super clear. I would also say just some general slide hygiene stuff like putting dollar signs. It's so often that we don't see dollar signs on charts, and it's really hard to interpret what that actually means. So just even having somebody else check it for you and just make sure it all makes sense. And then I also really like this one for when you're doing cold outreach, is to make your slide title a 1-sentence description of what it is you do as a company, because I think that means you can just really quickly show the investor when you send it in the email what it is you exactly do without them having to scroll through your 12 slides to work it out. So that's more, those are more on the slide deck. On valuation, I can just say it is definitely more of an art than a science. And really with the market at the moment, it's all over the place. So I don't think giving guidance is really super helpful. I just encourage you to, just have an open conversation with the VC that you're working with.
Bella, anything to add there?
Anything I'll add to those, I think, agree with all of it.
Yeah, and Liv, I think you touched on the next question I had around slide decks, which is
also a bit of like an art and a science, it seems. Like, what's the right structure? What's the right story? What's the right, like, what are the right metrics you want to add? So thank you for jumping the gun a bit on that. And maybe a question for Casey, like, should a founder think about maybe like overseas VCs? What's your thinking around that, especially for like a first time founder?
Yeah, this is a really interesting question. It's very topical because I think it's coming up more and more, and that there are more international VCs like making their presence known in Australia. And so it's more of an option than ever, not having to go to the US. I mean, a couple of things come to mind. I think the way that we have a relationship with founders at SquarePeg is we find that that relationship is best and easier when they're kind of around the corner. And so if you're setting up locally, like it just, I feel like it's made the relationship better for us. We were just talking about an example earlier with one of our partners just came back from Israel. He was living in Tel Aviv for 9 years. And the founders that he works with in Tel Aviv, like he had an amazing relationship with, and he still does, but it's not quite as nice as when they were like around the corner from each other. So there's that like factor on the personal element. I forgot my second point. Here's the COVID brain kicking in. I was going to say, the commentary I hear from founders a lot, which is like, I need to raise from the US because Aussie founders are, like Aussie investors are way too risk averse. And I feel like I'll be more likely to get funding in the US. I feel like more and more Australian VCs are moving earlier and earlier, and they've had to adjust their risk tolerance as a result. And so I think that's becoming less and less true. There's also just like an enormous amount of funding coming into Australia. And so I wouldn't wed yourself to an US VC because you feel like it'll be more likely to get funding. I think that there are many really great Australian options, and increasingly so. But I definitely think that if, launching in the US, for example, launching in Southeast Asia is really important to you, then you can press on those matters when you talk to those VCs and really ask them for explicit examples. Hey, how have you helped some companies in your portfolio expand to the US? How have you helped them in Southeast Asia? What are your connections in Southeast Asia? I really think that it's a two-way relationship, right? So don't be afraid to drill them after they've spent, 40 minutes drilling you on your business.
Yeah, no, completely agree. And I think just based on everyone on the panel, everyone's done very, very early investments. So I think things are really shifting in terms of where people are choosing to invest here, which is awesome for people like us.
Just to add one thing to Casey, and agree with all of it, I think that if I was in a founder's shoes, I would say, what do I want from a VC partner? And typically that's 3 or 4 things. It's hiring help, customer and strategic introductions, and a sounding board for a journey as a founder, which many say, and I can attest to, is a lonely journey. And then the 4th being kind of help expanding into new markets. And so I think what we see a lot of, and we've helped companies, actually a couple, there's N-Border, Go One, Assigner. They've all now taken money from SoftBank, Tiger, and smaller funds in the US, Stage 2 Capital, and a number of others. And what they have said is it's awesome to have that kind of help on the ground, so you can give someone a call when it's in your time zone to begin with. And then there's always a really interesting option, which we advocate for in later rounds and as companies, want to make their move into the US, which is, how do you bring on kind of a joint structure where you still get the support in Australia for hiring, which your product and development team typically is, but also get that expertise of someone, in the US and in particularly in the States that you want to move into. So I think there's a kind of, you can do both, but I would say it really depends on what do you want from the VC at the time that you're raising.
Great answer. Cool. Let's move on. So we've chatted to the VC, and then they're like liking what you do as a founder. And so things are getting serious now. And I think this is the part where things get very murky. At least I think that's what Earlywork felt like. So I think there are a couple of things that like we would have wanted to know. So I guess the first one is if you do get an offer from a VC, it could be a verbal one. Can you actually go to others and shop around, so to speak? What are the rules? What is the etiquette around that? Maybe start with Liv.
Sure. I mean, so firstly, there's kind of two elements. So the first one is sometimes the term sheet that you sign will have a no shop clause. So that clause is a clause that says you can't shop this around, you can't show other investors, it binds you in confidentiality. So just make sure you check on that one. My second point would be, I think typically it would be very strange to get a term sheet and then completely go to a new investor and say like, oh, look, I've got this term sheet. Don't recommend that. But it is a really common situation to have multiple different investors that you're all having conversations with, and one person gives you a term sheet and then you feel really weird about the conversations you're having with other investors. That's super normal. And I don't think anyone should feel worried about that. In fact, that's an amazing position to be in. So you should feel great about that. I think the most important thing is just really clear communication. I think I really appreciate it when founders message to me, you know, we're expecting to get this term sheet. It's not usual for people to talk about who the term sheet is from or who the terms are, what the terms are like. So I would just be, you know, really careful and mindful of that. It's all kind of common sense stuff that I'm sure all of you would be aware of. But just make sure you manage those relationships with really clear communication. That would be my main piece of advice. And then ideally what you can do is have multiple different term sheets kind of come in and compete, and you are obviously allowed to negotiate from those points onwards. But yeah, communicate.
And don't break the law, I think is another
thing.
Yes. Casey, Bella, anything to add? Bella?
The only thing I think, you know, when you get a term sheet, you typically don't have to sign it straight away. So that's the other, like you absolutely can go and, you know, if you're talking to multiple VCs at the time, you know, you can go and say, I've got a term sheet, what, you know, am I progressing through your process or not? However, I would say that there's been multiple times where, you know, me, Casey and Liv have got lunch or many others kind of using as an example. And, you know, we're very close and also talk like founders do in, you know, when we're not bound to confidentiality and in some instances, you know, you're not at the very beginning of processes. And so when you overstretch what one VC has said or promised, to another VC, it's probably one of the worst things that I've seen because it diminishes your credibility and we're investing in you. So I would just be careful on kind of, you know, I would stick to very clearly the objective kind of what's happened, particularly in circumstances where you're trying to negotiate yourself a better deal against two VCs.
Speaking of lunch with other VCs, the first time I ever got lunch with Bella, she was insisted on us getting pho, so I feel like she's a pho expert, just as an aside. But to those points, I just wanted to add one small thing, which is I think that what helps is running a tighter process. If you run like a really drawn out process and you're talking to one VC and then you're talking to another and then you're talking to another, you might end up in the case where you don't feel like you've run a competitive process. You've just kind of spoken to someone, now you have a term sheet, and then there were like 10 other people you wanted to speak to, but now you're in this awkward position of needing to give them an answer, you know, within the next couple of weeks, but you still haven't spoken to so many people. So if you run things on a bit of a tighter timeline, not only does it help you get back to the business faster, but it makes it a bit more competitive, because then you can be like, oh, well, actually, I'm expecting a term sheet here, and, you know, adds a bit of pressure and keeps VCs on their toes.
And clearly VCs are very small worlds, especially in Australia. Everyone seems to know each other quite well as well. And last question before we go to some audience things. What are the things that founders should negotiate on? And I think specifically, and this came up in the chat as well, like how much equity should people be giving away? Because I think this is where things can get very like difficult to comprehend. So I would love your thoughts on that. And maybe Casey?
Yeah, this is a tricky one. I don't have as much exposure to the terms as other VCs do, so I'll caveat that. I think the only thing that really comes to mind is just making sure you feel that the terms are pretty standard, you know, looking at what other people have term sheets listed online, like I know Airtree does as well, and you can kind of figure out what are similar terms, and of course a lawyer can help you with that as well, just to make sure no one's put anything tricky in there. That's what I would be thinking about. On equity, the giveaway, I think it's kind of personal, based on, you know, what you're willing to go away for the business. I think it can also depend on how capital intensive your business is going to be. You know, like a fintech has very different capital requirements to maybe a simpler SaaS company, and so that factors in as well. But yeah, not my area of expertise.
I'm happy to go next. I would say that you don't need to be the master of all trades. Consult with other founders, us, lawyers early, like not in a weird, like I need your legal advice and charge me $1,000 an hour. Like, you know, what does this look like? And what, you know, when you've never done something before, yeah, go for your life in asking questions from different people in the industry or that you can trust. And I would do that earlier than signing a term sheet. Typically lawyers get involved post term sheet, but actually the most important terms get dictated in the term sheet. So as a founder, I would be really wanting to front run that. And then to the equity point, I think Casey earlier kind of mentioned it, and this, I would say, what do I need to get my business to, or what milestone do I need to hit for either me to be break even, for me to raise X amount of money at a Y valuation, and what capital do I require to get there? Your first round of capital is hopefully always the most dilutive. So to be really prudent in what do I need to get to those milestones where I can raise capital, which will be less dilutive and hopefully at a higher valuation.
I can't add anything to those excellent answers.
Yeah, and I think that just comes to, like, you know, the art versus science part. You just got to work with what you have sometimes and, you know, see if it sort of fits with expectations. Cool. So I'm seeing a lot of questions come through in the Slido, which is very exciting. So I'm just going to open it up on my screen so I can see. But yes, if you guys want to ask any more questions, because there are a couple in here, but if you guys want to upvote, just going to drop the link in one more time. So feel free to drop in a question, put in your name as well, so we can like call you up. Although I'm seeing a lot of anonymous questions, so I guess I will do a bit more talking. The first question in here is, thoughts on crowdsourcing. And I think to add a bit more scope to the question, what do you guys think about non-dilutive funding and other like VC alternatives that we're seeing these days?
Yeah, awesome. We had actually Casey and I both had one of our portfolio companies, ZeroCo, recently go through the process of doing a crowdfund raise. And I think, I mean, for a consumer business, there are some real benefits in terms of customer acquisition for doing a crowdfund. So we're absolutely open to all of our companies going down that route if they'd like to. I would say, you know, probably from that experience, it is a lot of work, bringing in, you know, a range of retail investors, setting up the platform. ZeroCo's crowdfund actually crashed the virtual fundraising platform. So hopefully they've upgraded the tech so your super exciting startup won't crash. But yeah, I mean, I think that and other different types of funding. One thing we do at Skip is, because we're a private investment fund and we do not have the typical fund structure, we can actually do debt instruments for our companies. So debt is a really interesting way of, if you're a particularly capital intensive business, like some of the infrastructure investments that we invest in, or if you're in deep tech or fintech and need to set up a warehouse, then we can sort out those kinds of arrangements. And I would highly encourage doing that, because if you model out over time, sometimes really capital intensive businesses and the dilution this creates for the founder, you don't end up getting to see as much of the upside that you really should as a founder. So definitely do explore those options, especially if you are a capital intensive business.
Awesome. Maybe I'll move on to the next question just so we can get through a couple more of these. Kai actually submitted a question before the event. So Kai, if you're around, feel free to unmute yourself and ask a question. Actually, I'll take us all off the spotlight too, so we can see everyone who's asking questions.
Hey everyone, thanks Marina. Great insights and thoughts. I appreciate your take. Look, I'm just trying to think back to exactly how I worded the question, but I think in essence it was around the company focuses that VCs take when looking at who they invest in. It sounds like the different firms that you're all at are all comfortable with early stage, even pre-seed, but interested to just generally hear thoughts on, why a VC might go, hey, we're only looking at Series A onwards companies versus sort of funds that are happy to go, no, we'll talk to someone with pre-revenue sort of stage conversations. Interested to hear thoughts on why a VC makes those decisions.
I can talk about why Squarepeg decided originally to be Series A and Series B. So most people, when I speak to founders and say that we do earlier stage, they're like, oh, really? I thought you guys did only Series A and Series B. And certainly our website said that until very recently. But in recent years, we've gone to pre-seed. We also have a post-IPO fund now. So pretty full spectrum. But originally when Squarepeg, founded in 2012, was looking at markets and looking at what did the different stages look like. The information that you got at Series A was so much higher than the information you got at seed, but the price delta wasn't very significant. And so you weren't actually paying that much more of a premium to get in at Series A, but you were getting a lot more information about how the business was going. And so from that, like when you kind of adjust the risk versus benefit, it seemed like you get a better payoff at Series A. VC is all about numbers, power law distribution, etc. And so that made sense to the founding partnership team. But that's not true anymore, I don't think, in looking at how quickly valuations can escalate, particularly post Series A, and you just kind of need to, more and more founders want to have that longer relationship with their kind of first believers, and those investors that are going really early and have really big funds, as those kind of funds have evolved, they can afford to both go early and continue to back that company, such that they don't really need to go out to other VCs with big kind of checks. So that was Squarepeg's thinking.
I would also just add to that a couple of interesting things about the way a fund is structured. So one thing is that in Australia, there is this long acronym, but it stands for an early stage venture capital limited partnership. And if you're a fund and you want to have this type of arrangement, you can get a tax benefit, but it means you can only invest in Series A and below, so early stage companies. So there are many funds in Australia that abide by that fund structure. So that's why they'll go earlier, because they give their LPs the tax benefit. In terms of why some companies go later, I would just echo what Casey said. The risk return profiles are different. I would also say the style of investing is really different. We've done a lot of growth investing. And yeah, you just look at different things in those types of companies. When we look at a growth investment, we focus heavily on the financials and on the metrics. But when we do a pre-seed investment, we're talking to someone who just has an idea and they don't have any product or any revenue. So the focus is really on the person. And that's actually two very different styles of investing. So there are different funds that have different, backgrounds or experience or preferences in terms of what they like doing, whether that be heavy financials, whether that be really getting deep into the team and into the problem. Yeah.
I think the only thing I have to add to that is looking at it from a founder's perspective and maybe flipping that question on its head, which is, as a founder, how do I know what I'm looking for? in investors, and I think and different funds, and I think the way to look at it, you know, as a founder at different stages, is to say, what do I need the most? Is it that I need hiring help? Is it that I need expertise going to the US? Is it that I need none of the above and I just wanted to get the highest valuation? And then how has that investor or investor group helped other companies at a similar stage? And can I see that evolution? And then the other thing that I would say is, you know, have a look at, you know, what the fund structure is. So, you know, if it depends, you look at, you know, what size of check they're writing, and you have to right size it for the fund as well. And to say, you know, do I want huge amounts of attention? And if so, will the check that they're writing into our company give me that attention or that focus that I need from the fund? And so I think, you know, all different founders need different things on their journey, and just to kind of cross-check that with, you know, is that investor going to provide me with what I need for the next, you know, 12 to 18 months?
That's a really interesting point. There was so much, you know, so many people talking about Tiger Global last year because they were making an investment every 1.3 days. If you make 280 or so investments a year, it's very difficult to give all of those investments the same level of attention. And yeah, the easy way to check that is like, look at their portfolio. How many people are they fitting into each fund? How much time are they going to be able to dedicate to each one?
Awesome. Sorry, just going down the list here. Next one. So, oh, this is an interesting one. Great to see an all-female panel. General advice for female founders, and how can we change the narrative where 2% of capital goes to female-only founder teams? Great question, Anonymous.
The sad state of affairs, isn't it? Were you going to jump in, Bella?
All I say is, like, top of funnel, there's nowhere near 50%. So, like, we need to keep incentivizing female founders to get out there in the first instance. I don't think it's just a function of not getting through. I think it's really top of funnel. How can we help other people and kind of share our advice and learning and incentivize other women and everyone in the environment to kind of help and support each other.
Yeah, someone in the chat just mentioned a great female founders grant. I think they're talking about the Boosting Female Founders grant, maybe, which is one to check out. But I agree with Bella. I feel like there are still structural issues affecting the top of funnel. Like, women are often given more labor at the home, particularly unpaid labor, and that can make it difficult to have a startup, which is very intense. The other thing I've heard before is just like what I've heard from other women VCs reflecting on this is that women, at least they feel that they've noticed that women almost like give more pragmatic, like are more pragmatic in their vision, and that can cause them to like even understate what they'll accomplish. And they say that, like, if a woman tells you they're going to hit 100 users, they hit 100 users, and maybe men will overstate and, you know, fall short of that. And so I think maybe don't be afraid to kind of lean into your own vision, because VCs do get excited by exciting big vision, because we're kind of vision people with our heads in the clouds. But my colleagues, Jessa and Lucy, actually wrote a great blog post on their reflections as well, which I'll share in the chat.
Again, can't add anything to those amazing responses.
Awesome. Then we'll move on. Oh, actually, this one I'll call Max if you want to unmute yourself and ask a question. Let someone else do the talking.
Yeah, sure. Hey guys, this has been really good. My question is a classic one, and it's how soon to chat to VCs. On one hand, you have Blackbird advocating that it's never too early to chat to us. And the advantage of this is that they get to know the founder over a longer period. But there's probably a point where it's slightly too early to chat to the VCs because the founder hasn't sharpened up their messaging, hasn't released the branding into the wild, and branding shapes perceptions. And I guess, like, to clarify the question, this isn't how soon to start fundraising. but it's how soon to actually introduce your idea to VCs.
Yeah, I'd love to take this one. I absolutely love speaking to founders prior to the fundraising process. It is just such a good experience for me, for them, because when they go to fundraise, it's like, oh my gosh, how have you been? Rather than the fundraise process, which is often, oh my gosh, we've got 20 meetings in 1 week and we've got a pitch and stress. So I would absolutely encourage to reach out to VCs before you're planning on raising and just develop relationships, particularly if you really like the VC or you resonate with the message that they're kind of trying to invest in. I think that that's a really great idea. But I think, Max, you touched on a really important point. I think you don't need to have like a branding in the wild. You don't need to have a product, but you do need to know what it is that you're building, and you do need to know how to communicate that. I think that's probably pretty obvious. I don't think you have to have everything sorted out. And I actually quite like going on the journey of founders where they're saying, this is our 10-year vision, but there's all these missing pieces in the 5-year stage. Can we just chat about it? Where we absolutely love doing that and love investing in founders where, they are really early and we can go on that journey with them. So I would say, as long as you can clearly communicate what it is that you're working on, you don't need to have a pitch deck. You don't need to have really polished branding. We've seen some of our investments kind of come to us with this, what I would say is not a beautiful pitch deck, and then kind of re-emerge with this refreshed brand that looks amazing. And that really can come a lot later.
Used to drive me a bit crazy in our file management system. There was like these folders and references to something called NPC. And for the longest time, I was like, what is this acronym? And then after a while, someone told me that when we first spoke to Zella, they had no branding. They didn't even have a name. They were called New Payments Company. And so we just acronymed NPC everywhere to refer to Zella. And so you don't need branding and you don't even need a name. I think what you need to understand is the problem. The Zella guys were both at Square, so they understood small business banking exceptionally well, and they understood how that gap needed to be filled. And so they had this broad outline of how they were going to fill that gap. I think you need to understand those two things before you come to a VC.
Bella, did you want to add anything to that?
No, I think, yeah.
So I saw you unmute yourself, so I was like, oh, maybe.
I didn't want to be the person that someone had to say you're mute. So I did anticipation for when I next wanted to speak.
Maybe you can answer the next question first then. So this one's top rate, like most voted actually. So making the decision to bootstrap versus when to reach out to VC. I guess it's similar to Max's question, but then I think the difference is like, when do you intentionally tell yourself to go bootstrap as opposed to seek funding?
It's a great question. And it comes down to a balance, which on one hand, going to take investment is essentially giving up part of your company. And you are selling shares. And so, on one hand, bootstrapping allows you to retain 100% of your company, but on the other, it depending on how profitable you are, which is quite rare kind of when you're just starting out, it comes at the cost of how quickly you can grow. And by grow, I mean add resources to development, product, sales, and marketing. And so what I would look at is how do I get myself to a position where I can convince a VC or an investor that I have something and have traction in the market enough that they believe that I will be 10 times the size of where I am. And that comes in lots of different ways in order to optimize the value so you don't have to dilute yourself too much as a founder. And that point comes at different times, depending on businesses and how much capital you need and sector you're in. But that's kind of always the two things you have to weigh up.
Liv, Casey?
I mean, I would just add two quick things. The first one would be, when you think about raising, I would just make sure you ask yourself, am I raising because I've got a clear pathway? And this is raising venture capital. Am I raising because I've got a clear pathway to spend that money? Or am I raising because I think that's what makes a successful startup? Because it's absolutely not the case that you need to get venture capital to be a successful startup. Obviously, Atlassian is a fantastic story of that, but there are so many others. And I would also say that choosing to bootstrap for the start of your company when you have no need to raise, then that does not preclude you later from raising venture capital. So we've invested in companies like Delegate Connect, who for the large life of their company had amazing growth and were completely profitable and only decided to make a change later in their life. So you don't need to raise like right from the beginning just because, I don't know, venture capital is very popular.
The last factor is just sometimes it's not a venture business in the first place. I have heard some founders lament the fact that they went with VCs because then they had an added level of pressure to grow in the way that VCs expect. They expect that kind of 10x outcome or even more. And so if it's not a business that is suited to that kind of like venture growth, then maybe it's not suited to venture capital. Maybe there are other angles like debt that we were speaking about before. So that's another factor to keep in mind.
All really great considerations. I think maybe last question before we wrap up. This one's interesting. So would you pass on a startup idea if their revenue avenue wasn't clear, even if the idea is refreshingly new, popular, and scalable? Great product, but no business model, it seems.
No, it's a simple answer. No, I think there are plenty of businesses that we think about where the revenue avenue isn't, like maybe the founder has ideas. Might even argue like Canva was kind of in that bucket. I mean, I think having looked at their earlier decks, they had some ideas of how they might monetize, but it's quite different to how they do today. But yeah, it wasn't super clear. And obviously people talk about Facebook as well, where for years they were harassed about not having any revenue coming in, and the fact that they'd never be profitable, never make money, etc. And obviously they do now. So I think there are some clear, very prominent examples of companies that have gone on to make revenue even without a clear path in the past.
Yeah, I would add to that. We just recently invested in a company alongside Sequoia, which is a gaming infrastructure company called mod.io. They have an awesome offering and product in market, and will continue to refine kind of the business model. But I think Dan put in the chat, Instagram was bought for 1.6 billion without revenue, and that was probably a great buy for Facebook. So yeah, I also would say that like VC, and this is more broader, but VC is not the like North Star of is my business good or not. VC is a framework of, is this a scalable business where we invest along a certain criteria. We're not experts in media companies that are, or infrastructure kind of, capital intensive businesses. So for us to say it's not for us is 100% not, doesn't mean that it's not a good product. I met a company today which is bootstrapped, doing $5 million of revenue in the last year, and is kind of a consumer company. It's not for us, but God, it's a good business, and would love to be the founder. So that would just be my other comment.
Great points. I think we have time for one more. Henry, Ines, do you want to ask your question? Unmute yourself, say hi.
Hey guys. Hi Casey and Isabella. I've seen you guys a few times. So I was just wondering, throughout a process, what information do most founders typically not provide you guys? But do you actually value the most, or you think that is incredibly valuable. So are there any kind of asymmetries there in terms of, you know, information you wish founders provided, but they just consistently didn't?
I'll go first, and mine's a very quick one, is when you're an early stage business, really, a lot of the time you have a couple of early customers and, you know, you have on paper what the revenue is or what the idea is. And what is really important and something that is so easy to demonstrate how critical your product is to get customer testimonials. And I'll do a hard plug to one of our portfolio companies called Vouch4, which does customer testimonials. But to be able to see video or things that customers are saying is much more powerful than just to say it yourself, like anything in life.
I was going to say customers early on as well, and maybe even an element of like just understanding more about the team and their experience, like getting exposure to the broader team who you've hired is kind of useful in the early stages as well. Later stages, it's like, it's also kind of like customer reviews, but also NPS and a bit of like cohort data, which is more of those like user behaviors, how often they're using it, etc. But that's more when you have that kind of data more consistently.
Yeah, I probably have two. So my first one would be, if you're an early stage company, investing so often orients around you as a person and you as a founder. And, you know, my first question whenever I meet companies is, you know, how did you come up with this idea? Like, tell me about yourself, like what led you to found this business? And I tend to find people's team pages like buried in the back of the deck. But, you know, I want to know who you are and how did you come up with this unique insight that helped you really build this really interesting company. So definitely that one. And then the other one for us in particular is product demos. So we're really product focused investors, comes from a bit of the kind of Atlassian product led growth story. But we love to dive deep into someone's product. And so for me, seeing even a 5-minute loom where you're just kind of like clicking through your product so I can see what the experience looks like, I can get a sense of, you know, how the UX is set out and what exactly the product does, that is super helpful for us. And I also think it's a very scalable ask, like just putting together a quick 5-minute loom. You can share that with all of your other investors. So I think that's a great tip to include.
I'm so glad you said the thing about the team being buried in the back, because I thought it's a bit of a conspiracy that everyone always puts it at the back, and I love it being up front. I want to know that first. So I'm so glad someone else has said that.
And when people put just the picture of the logo of the company they work at, I'm like, what did you do there though? Always stalk on LinkedIn afterwards. But no, I'd love to hear more about you and your background and like exactly what it is you did at that company, because I always come away better for it.
Bella, want to add anything? Cool. All right, I think let's wrap up there. We'll do a last round of shilling. So Bella, Liv, Casey, actually we'll go one by one. Let us know what you want to plug, where we can find you, anything you want. Bella, over to you.
You can find me on Thursdays at 4. I'll also put my number in the chat. Feel free to Slack or WhatsApp me. Not Slack, WhatsApp me. Yeah, always best on WhatsApp. And yeah, find me on LinkedIn or in person.
So, Liv, over to you.
Yes, so I will plug myself and Skip. I'll put my email in the chat afterwards. Please do reach out. Just love having general chats with anyone at any time. Oh, thank you, Dan, putting the LinkedIn. And yeah, just please do reach out if you've got an interesting idea, even if you're not ready to raise, even if you want to talk more about this topic, I'm happy to always have a chat.
All right, Casey, over to you.
You can find me in the Earlywork Slack. So you can find me there, message me there, or I think my email address is on my profile in there. So yeah.
That's what we like to hear. And yes, if anyone's new to Earlywork, we do a lot of events like this pretty often as well. Come join our community, subscribe to our newsletter as well. And yeah, like I think we're all very grateful that we could all bring together such a stacked panel and talk about very no bullshit VC things. So once again, thanks everyone for tuning in, and we'll catch you all later. Bye, everyone.
Thanks, everyone.
Thank you.